Hey folks, it's Rob Flux here with another Sunday session, and today is open mic night. So open mic night is where you get to send me the questions by clicking on the links that are going to appear right below. And in doing so, that allows me to do a little bit of prep and then we can actually give you the answers that you're actually looking for. So if you've got any questions, we've already got the questions for this month, but if you've got any questions, make sure that you click the link below, and the first Sunday of every single month, I will do open mic night and attempt to answer your questions as much as humanly possible. Now, that said, this week we didn't actually have a huge number of questions come through. So my team have trawled through Facebook and tried to find a couple of your questions that have been in our Facebook community. And based on that, we're going to try and give you a full show. But for next month, folks, please give us some questions. Give me something that's really going to test my brain and see what it is that we can do to actually help you. Now, that said, the couple of questions that did come through the official channels, one came through a person called Pia. So Pia asks, is it correct to say that the date of an approved certificate let's do that again. The date of an approved certificate of occupancy, or OC, is the date of the completion of the works. So that's the question. Well, technically, no. So technically, the occupation certificate is telling you that the house is legally fit to be able to live in, but it does not mean that the works are actually complete. The builder may still have a whole bunch of works that need to happen to actually finish the project, and that is what is called handover. So when the builder gives you handover, that's when, I guess, the works are technically complete. Now, even at that point, folks, there's still going to be some minor defects that you need to actually identify and get the builder to actually remediate. So my guidance to you is, as part of your negotiation in doing the contract in the first place, you want to negotiate with the builder to say, hey, those minor defects, I'd like you to accelerate those being repaired, because there's no actual fixed timeline for those. It can take months, even a year, for them to actually fix the minor defects. But if you have a small amount, maybe 5% of the construction price actually held back, you get an independent valuer to actually, building certifier, I should say, to come by and inspect the building, find the minor defects, give that report to the builder, and when they are done, you, I guess, pay the balance. That way, the builder has an incentive to actually complete the works, and it also means that you're not going to be interrupting any tenants or sales or anything like that in the process. And you know comfortably that both yourself and the builder can move on to the next project as quick as humanly possible. So in conclusion, the occupation certificate is not I guess the official completion of the project, but rather it is the legal definition to say, hey, it's actually a legally habitable building. So it's waterproofed, the taps are working, the toilets flush, it's lockable, all those sorts of things, but it doesn't necessarily mean that all the fixtures and fittings are to the finished quality. Anyway, hope that helps, Pia. Next question comes from Vivi. So Vivi says, I'm new on this journey. How to start the journey with property development sites. Unsure how and where to start the property development journey. So Vivi, the first thing that I would suggest is please make sure that you actually come to one of our networking events. We run networking events all over around the country. So we run them in Brisbane, Sydney, Melbourne, and Adelaide. I've just put the link for those down below. That's going to give you, I guess, the ability to immerse yourself in with a whole bunch of people who are actually doing the process. And we have a masterminding process that actually happens there, where you can actually ask all the people, how did they start their journey? Okay, so things like, how do you choose your development strategy? Where do you choose your areas? All those sorts of things. The best people to ask are the people who have actually done it. So make sure you actually come to one of those. It is $25 to attend one of those events, or $250 to attend for the entire year, with every single event all the way around the country. So that's a fantastic place to start without spending huge amounts of money on expensive courses and things like that. Now, that said, we obviously do run a course. We actually teach the process. We help you to actually identify what your development strategy is and that sort of thing. That is called the Property Development Formula. So if you're actually interested in that, there's a link for that below. I'm not going to do a sales pitch on that, but just know that that is, I guess, open for you. Now, all of that said, the most important part to the entire process is getting your development strategy right, understanding what your development strategy is going to be. There are hundreds and hundreds of development strategies out there, but my guidance to you is choose one strategy and get very, very good at that one strategy. If you do that, all of the next of your problems then start to become much, much easier. So what course do I do is going to be based on the strategy that you've chosen, because it's going to be the course that teaches you that strategy. Where do I start to farm? Well, that's going to be much easier because you're going to go, I want to farm in areas where that strategy starts to work. All those things start with decision number one. What is your development strategy? Now, there are lots of strategies to choose from, but they're fundamentally only two paths where you can scale your development strategy. So the first thing that you want to think about is, if I can start by doing a small project, learn some skills, and then reapply those skills again in the next project, then how do I learn from that and get better and better and better at the process? So a subdivision, for example, I can start with a 1 into 2, then a 1 into 4, then a 1 into 6. I can go on and build entire suburbs. I can go on and build entire cities. Okay, so very, very scalable. Also, you could do townhouses. So I could start with a duplex, then a 4-pack, then a 6-pack, go on and build 20, 50, 100 townhouse type projects. Equally, if you want to do apartments, so townhouses and apartments have very similar rules in the early stages. So we could do units at grade. We can do 2 stories, 3 stories, 5 stories, 10 stories, etc. So they're the strategies that are going to help you to actually scale. Come to one of our meetups, go through the pros and cons of which ones might actually suit your particular circumstances, and then choose which course is actually going to help you to actually learn the skills in order to do that. Anyway, I hope that helps, Vivi. Okay, next question. Alan says, I've purchased a site and, if I purchased a site and ascertain a CDC complying development code with a private lender, will a private lender lend me the whole construction loan? So firstly, Alan, I don't know your personal circumstances, so I don't know if they will lend you the entire amount. What I will say is that fundamentally, there are 2 different kinds of lending approaches to take. One is residential lending, okay, in which case you need to demonstrate to the bank your serviceability. You need to demonstrate to the bank your intention of actually keeping that stock for 20 or 30 years. And they're going to try and prove that you can actually afford to fund that loan over that 20 or 30 year period. So that's if you go down the residential lending path. If you go down the more commercial path, and there's, I guess, funders that specialize in development lending, okay, then they're going to look more at the deal itself. Now, in doing so, there's a couple of little catches with this, okay? So typically, they're going to want to have a development approval already in place. So CDC, being a complying development, is a fast track approval to actually get the approval in the first place, okay? It's only for New South Wales, but if you can get that, then your ability to, I guess, demonstrate that the deal is profitable, if you can do that and you've got enough equity, then absolutely they would likely help you to get there. But if the site is raw and you've never done a deal ever before, then they've got no guaranteed exit strategy and they've got no guarantee you're actually going to get the approval. So getting a private lender at that stage might be a little bit challenging. So be very, very careful, I guess, when you actually get to the point of settlement, make sure you've actually got a development approval in place, especially if this is your first deal, and make sure the deal is actually a deal, and also make sure that you've got plenty of equity in the bank. Otherwise, you're going to have to go down the residential lending type path. Hope that helps anyway, Alan. Next question from Paul. How are people structuring joint ventures with landowners? Am I correct in assuming that the landowner will also need to be the borrower for the construction loan? Is the JV agreement a project management agreement or something else? Okay, Paul, I've got to be very careful here, because when you're asking how to structure the loan, we're talking about, or the deal, we're talking about what entities you're going to put it into, that sort of thing. I'm not legally allowed to give you accounting or financial advice. So I'm going to be very broad in nature here. I'm not going to drill into your own personal circumstances, which I don't really know. But as a general rule of thumb, okay, the landowner is actually providing the land as their contribution into the joint venture, and typically that's going to stay in their own personal name. Typically, not always. They might choose to actually change entities for taxation reasons. They'll need to talk to their accountant on that. And yourself as the developer would then come in and do a joint venture with them, typically with a development entity that has been set up specifically for that particular project. Now, that entity could be a company, it could be a trust, it could be a combination of those things, but that doesn't really matter. You'd put a joint venture a joint venture agreement between the two parties to actually, I guess, demonstrate that you're actually going to be doing a deal together. Okay, now when you actually go to get the construction loan, because there's a joint venture, both parties are, I guess, invested in the success, and both parties are going to be impacted by any mistakes on that. And so both parties will need to actually be on the loan. Now, the lending institutions have a legal obligation to say that if someone is going to be a benefit of the, a benefit of the loan, then I guess they need to actually be on the document itself. So the landowner, for example, they can't just give the equity out of the land and not actually be on the loan itself, because they're being impacted by the loan. So yes, in short, they will have to be on the loan to actually help you through, because their property is actually the equity that you're actually tapping into. So I won't go into the actual entity structures and the best way to actually do that. You really need to talk to a solicitor for, I guess, your asset protection side of things, and you also need to talk to an accountant for your tax minimization side of things. And you'll also want to talk to both of those people for the impact on the landowner as well. Okay, there's lots of impacts on the landowner, and you want to make sure that it is fair and equitable for them to actually do that. That said, many ways to actually make that happen. I'm not going to go into which ones they are. I do know the answers, but I'm not allowed to say. Anyway, I hope that helps, Paul. Next question is from Jen. Jen says, what are some fair ways of determining who gets the better parcel of land in a subdivision through a JV partnership? Jen, that's a really interesting question. I guess it's really going to come down to who is the major contributing party into the process. Now, if it is 50-50, then you might as well do rock, paper, scissors in order to choose who gets property number one to choose from. So I would say party number one gets first choice, party number two gets second choice, party number one gets third choice, party number two gets fourth choice. So you kind of do a round robin type approach if both parties are doing a 50-50 contribution. If, on the other hand, the parties are, I guess, a little bit unbalanced, so it's a 60-40, 70-30, that sort of thing, then the party that's doing the major contribution should be the one who is actually having the first choice. Okay. Now, you're going to need the other party in any way, shape, or form anyway in order to get the deal. If that is the one thing that's the contributing factor as to whether or not they're actually going to participate in the deal or not, and by them not having choice, number one, means that they're going to walk away from the deal and you can't do the deal any other way, then you've got some hard decisions to make to say, do I really want to give up that prime position? I guess and if so, maybe they could discount in some other shape or form. Now, doing that, maybe what you do is you say, well, the value of that land needs to be determined by an independent valuer, so that the joint venture is still I guess split evenly so they might get the better property, but you're valuing the property at its true market value, and then you're not actually financially impacted, I guess emotionally impacted, so to speak. So anyway, I hope that helps. Next one, Kui asks, can anyone please advise if capital gains tax applies to the principal residence property being subdivided and multiple dwellings are being put in Victoria? Please. Kui, this is an interesting one, again, because you're actually asking for taxation advice, and I have to be very, very careful that I'm not allowed to give you taxation advice. However, there is some really good articles on the ATO that actually go into and describe this exactly. So if you Google that exact question on the ATO website, you're going to get the answer that you're actually looking for. Now, in my reading that document, so this is not me giving you advice, but in my reading that document, I guess my lay interpretation of that is that yes, there would be some capital gains tax actually apply, I guess, to get it to that point. So principal place of residence should, in theory, be capital gains tax free up until a point. However, at that point in time, you are not selling it as your PPR. You're actually selling it as a development site. So yes, there would actually be some implications of that. Plus, you're now doing a development, so there'd also be some GST implications on that as well. So super, super, super important. One, you go and read that ATO notification, and 2, you go and talk to your accountant to make sure that you're actually structuring that the right way. There are a whole bunch of little gotchas and loopholes with regards to that. So it depends on the size of the land as well. So smaller blocks of land will have one outcome. If you're on larger rural acreage and that sort of thing, there's only a portion of that land that you can actually get your PPR status exemption for. So there's a couple of gotchas in and around that. So very, very super important that you actually go and talk to your accountant on that one. Okay, next one comes from Kumanen. Kumanen says, has anyone done a shed to granny flat conversion? Existing shed is 60 square meters. What's involved? The property is located in Brisbane. So there's a couple of things to consider here. Firstly, has the shed actually been built to National Construction Code standards? Okay, so if you're going to turn this into a habitable dwelling, then it needs to comply with the NCC, the National Construction Code. So some sheds will comply, some sheds will not comply if you're going to turn that into a habitable dwelling. So you may need to retrofit that, and so you're going to need a building certifier to actually approve that. The next thing you need to do is make sure that granny flats are actually allowed in that particular area. Now, every council will have a different point of view on whether or not granny flats are actually allowed. So you need to actually make sure that you look up your particular council. Up until very, very recently, Brisbane City Council would allow the dwelling to be created, but the use of that dwelling was very limited in its use, okay? So, for example, granny was the only one who's allowed to live in granny flat, okay? You couldn't sublease that out and subrent that out. Now, there has been some changes to the Queensland State Government legislation that would infer that you can now do that. But I guess that's very, very new legislation, and not many people have actually tested it all the way through. So make sure you're talking to your town planner to make sure that's a very good fit. Anyway, hope that helps. Next question, Simone. Simone says, my situation, I have a homeowner that has a large principal place of residence that can be DA'd into 2 sites. If you enter into a JV agreement with the owner, which allows you to do the development while they remain the owners keen to keep one block and the other block is sold. What is the tax implications of selling one block, if any? Do they keep the total amount minus stamp duty and conversion and conveyancing costs? Simone, because you're trying to do a JV, this comes back to the same question that we had a little bit earlier. There's a whole bunch of tax implications for the person who actually owns the land as a principal place of residence status. You really need to actually talk to your accountant on this particular one as to how that would actually apply. There'd be a portion of the block that they could potentially charge, I guess, claim that principal place of residency status on. If they are keeping that part as the side that they're actually keeping, then that's probably not such a big deal. But you're going to have to get some valuations as to what the property's worth right here, right now, just to make sure that I guess any calculations from a tax perspective are already accounted for. But you need to actually talk to your accountant to see the implications with the landowner on that particular one, because there are some gotchas on it and you don't want to unfairly impact them. Now, what your question was, though, is do they keep the total amount? Well, no, you're doing a joint venture. So no, they won't keep the total amount. What you've got to work out is what is the value of the land that they are actually keeping? What is the value of what you're selling? What was the profit split arrangement that you actually came into place with? Are they in front or behind on that? Does there need to be a true up after the sale of the land? Those sorts of things. Okay, but yes, you're going to have to pay tax. Okay, you're also going to have to pay, I guess, the agent's commissions, any conveyancing costs, or all those sorts of things. But it's the one property that you're actually selling here, so there would be no stamp duty applied in this particular instance because you're going to sell it from their name. But yes, you would be sharing the profits after all of those costs have actually been accounted for. Next question from Leo. Leo says, hi legends. Based on your experience, any idea how long it would take to find money partners? Do you usually just put a post and they find them just on Facebook groups, etc.? Any guide on what rate to offer? Thanks, and any tips would be much appreciated. Okay, Leo, get ready for this because this is going to be a long answer, mate. So firstly, there's a couple of things that you need to be very cognizant of. So there is some ASIC regulations that sit in around this, and you can't just go broadcasting on Facebook groups to say, hey, who wants to invest in my deals, and that sort of thing. It's just not legally allowed. My strong suggestion is that if you are an annual member in our group, and if you're not an annual member, then you can go to the shop and actually, I guess, join your annual membership there for about $250. You can actually go back and look at a back catalogue of a recording of a meetup that we ran about 3 or 4 months ago in Brisbane, where we talked about how to raise money legally. Okay, super important that anyone trying to think about whether or not they, I guess, want to raise money by asking questions in a public forum, you need to understand those ASIC regulations. Super important. Okay, I cannot stress that enough. I'm not going to go into an entire 45-minute presentation right here, but I will give you the gist of what you need to do. So firstly, okay, let's assume that you're going to do this in a compliant way first. Okay, waiting until you have the deal is too late. Okay, if you wait till you have the deal at that point in time, firstly, you're trying to ask complete strangers to know, like, and trust you in a very short period of time. You're trying to ask those people to go get their tax returns up to date. You're trying to ask those people to get, I guess, the financial approval and that sort of thing super fast. You're trying to get them to review your joint venture documents or your loan documents or whatever it is. So they need legal advice. Plus you're wanting to review the deal. Plus they're still trying to get to know you. They're trying to do all of that in a very compressed timeline. What you're really doing is you're putting a whole bunch of pressure on them, and you're going to squeeze them so hard that they're just going to burst, mate, and they're not going to come on board. It would be very rare for you to find an investor at the last minute when you've just got yourself a deal. Instead, what you need to do, you need to build yourself a whole bunch of rapport well in advance of anyone needing any money. Okay, so the 3 things that you need before you do anything: you need people to know, like, and trust you. Okay, if they do not know, like, and trust you, they will never ever lend you any money. Okay, so you need to build rapport months and months in advance to actually get people wanting to actually work with you. Okay, you want them to review your legal documents well in advance of you actually finding a deal. You want them to have any questions or concerns and all that sort of thing, understand their personality traits, get their tax returns up to date, get themselves deal ready well before you get a deal. And at that point, you've pre-qualified them as someone who's ready to invest in your particular deal. At that point, then you can just present the deal itself, and the only decision they're making is that a deal or is that not a deal? So where do you find people that already know, like, and trust you? Well, we've got this magic device here. Okay, this magic device here, every single person in that tends to know, like, and trust you. They know what you like under pressure. They know how you're going to deal with issues and challenges, and they know whether or not you're a nice person. They know how you're going to handle things. Okay, so they're the easy people. Problem is, they're the people that are the hardest for us to actually reach out to, because we think that we're going to hurt our friends if we lose money. So here's the clue: don't lose money. Don't invest in a deal that you don't think is a deal. If you are not going to go into a deal and put your hard-earned cash into a project, then why would you be actually putting any risk to those people? Okay, so if you think about it like that and you go, well, I'm not going to put my money into a dud deal, then you're equally not going to put their money into the same dud deal. So make sure that you're looking at and assessing the deal as if it was all your money in the first place. Okay. The next place, the Facebook communities are great. However, you don't just go asking for investors. Instead, pay it forward. Help people first. Answer questions. You've asked this question here, and people are responding and helping you. Me, for example. Okay. But it's when you help people, the more you can add value to someone else's life, the more people are actually going to start to like you, and they will invite themselves into your world. Okay. Now, I touched on the ASIC rules with regards to, I guess, not publicly broadcasting to say, hey, I actually want investors. Many people do this and they break the law. So you need to know what the law is. If you are publishing, hey, I would like to offer X amount of interest rate for someone to invest in my project, and you're putting that into a public forum where there are thousands and thousands of people, you are instantly breaching all of your ASIC rules, okay? Super important that you need to look up the ASIC 2012-2 rule with regards to what it is that you need to do. Now, the summary of all of that is in that that meetup. As I said, the Brisbane event, a gentleman by the name of Adam Jones was actually presenting that, and all about how to raise money legally. Again, if you are an annual member, then you can actually go and watch the back catalogue of that recording. You can go to the shop and actually, I guess, become an annual member for about $250 and have a look at that, and many, many other recordings of all the events we've ever run ever. Plus, you know, have a look at all the real deals and a whole bunch of other things like that. So you're going to get heaps of value out of that, plus all of our discount suppliers and a whole bunch of stuff. Okay, but very, very worthwhile. If you're thinking of investing any money at all, that is the first investment you need to do, is actually how to find out how to raise money legally. Anyway, hope that helps. There's a ton more I can actually go into that, but go and watch that particular recording in particular, Leo. Okay, Melissa's got a question. Can anyone advise whose responsibility it is to take out strata insurance for common areas, public liabilities, etc. in New South Wales when purchasing? Is this the individual owner, the buyer, or the body corporate? Melissa, it's actually the body corporate that looks after the common areas. Okay, you pay money into what is called a sinking fund. That sinking fund, I guess, so you've got quarterly contributions into that body corporate, and they use that to pay for all of the you know, the maintenance of the area, I guess the upkeep, you know, tending the gardens, getting the bins looked after, any insurances on the building, all that sort of stuff. So it is them. So you need to review your body corporate rules. You need to look at what the costs are to actually participate in that. Now, the name of the body corporate changes from all the way around the country. So sometimes it's called a strata manager, sometimes it's called a body corporate. Either way, the same concept actually applies. Okay, next one. So Patrick says, are there any private lenders that charge interest on used amount instead of upfront? No, Patrick, if you're looking at a private lender, generally there's two charges that would likely apply. One is called a line fee, and the other one then would be an interest rate. So a line fee says, if let's just say I want to borrow $1 million, and I'm going to do that for different stages of my project. There's going to be a drawdown of, say, $100,000 when the foundations are put in. Then maybe there's $150,000 when the frames go up, and we're going to draw that down progressively over the rest of the project. Okay, so the line fee would say, look, we have reserved that $1 million and we've put that in the bank so that nobody else can actually borrow it. So we're going to charge a line fee against that, a flat fee, and it's usually somewhere between 1 and 2.5% as an upfront fee that says that is just because of the fact that we've reserved that money. We can't give that to anyone else because we don't know exactly when you're going to draw down on that. Then as you do the drawdowns, then it's just the money that you've actually pulled down. So you don't get interest on the entire $1 million. The line fee is against the entire million, but the drawdowns are against what you actually drew down. So as I draw down 100,000 for the foundations, then I would get charged interest on that for the balance of the project. As I draw down the 150 for the frame, I would then be charged interest on that for the remainder of the project, etc. So I guess to answer your question, yes, they do, but there's also an additional charge. Sometimes there's other charges that go in there, what they call a success fee. There's also, I guess, legal costs and valuation costs and a couple of other things that tend to go into it when you're using private lenders. But just know that it can be done, but you'll need to shop around to see which lenders charge which particular fees. Next one is from Simone. Simone says, is there an easy way to find out who the builder/developer is for a project under construction or about to start construction? Absolutely, Simone. There's a legal compliance requirement that they must put their builder's license on the fence out the front of the property. So they're going to have their builder's number. It's going to have the site contact number. It's going to have their contact details, what to do from, I guess, an OH&S perspective when you're entering the site, and a whole bunch of other things. So if you are going past a property, then you can actually do that. If the project has already completed, then you might be able to look up the original development approval, and that would actually tell you who the architect was. You can actually go talk to the architect. They might give you some insights into who the builder was, because usually the architect and the builder worked fairly closely together. But otherwise, Google Street View goes past many times, and in some instances they might go past and actually capture that building, who the builder's certificate is out front. Sometimes they'll do that. You can actually go back and look at past photos of Google Street View and that sort of thing as well. So sometimes they go through very often, sometimes they don't go through very often. Depends on the area that you're in as to how popular it is and how much change is actually happening in the area. So Google might go through monthly in some areas, they might go through yearly in other areas, but that is also an opportunity for you. Next question from, I'm not sure how to pronounce that, Sibgat. Sibgat says, hey, Victorian developers, New South Wales has a thing called Complying Development Code. Is there an equivalent in Victoria? So firstly, the New South Wales Complying Development Code, CDC, it's a fast track approval process. So that is if you have very specific type of product that meet very specific criteria, the state government has a process where you can actually fast track the approval of that and not go through a council approval process. So Victoria does have something similar. It's called Vic Smart. Okay. The problem with Vic Smart is it's not very smart. Okay. It doesn't actually give you the approvals for the kind of things that you're actually looking for. So it's for things like garages and for I guess smaller constructions, maybe a shed, those sorts of things. So it's not to the scale that I guess the New South Wales CDC process actually is. You can look up Vic Smart and look up the kinds of approvals that you can actually get under that Vic Smart process. But I don't think, based on the typical projects that are happening in my community, I don't think it's going to apply for you, but very worthwhile to actually have a look at that. Next one, Abraham says, does anyone have any experience with an unsatisfactory pre-settlement inspection, and how do you manage to get a good resolution from here? Thanks in advance. Okay, Abraham, there's probably a couple of different scenarios here. So I'm not sure if you're buying, I guess, a finished home, or if you're buying a second-hand home or that sort of thing, or if you are actually the developer working with the builder. So process is slightly different for both of those. Okay, so if you are the developer working with the builder, super important that you actually in the contract negotiate this up front. Getting to the tail end and then trying to hassle it out at that point in time is too late in the process. So up front, when you're actually signing the contract, one of the things that I recommend, and I actually touched on it earlier in this particular presentation, is that you should negotiate for minor defects that you actually hold back a sum of approximately 5% of the construction costs. So when they issue you, I guess, the handover of the project, at that point in time, you'll get an independent inspector out to do an independent report to actually identify all those minor defects. You will then hand that report to the builder, and they have a set timeline that they need to come back and actually remedy those. And then, and only then, will you actually pay the balance of the project out. If you don't do that, then I guess by the time you get to handover, you've actually forked out 100% of your costs up front. You then have some minor defects, and you've got no stick that you can actually beat up the builder with. Not that you want to beat your builders up, just for the record, but you've got no incentive for the builder to come back in any hurry. So it gets very tricky to actually do it at that point in time. Similarly, if you're, I guess, buying a property and you're doing a final inspection, unless you have actually identified, I guess, that there's been some, I guess, deliberate breaches to things. So, you know, maybe the house was in really good condition when you purchased it on your original inspection, then you go back and somebody smashed a wall in, for example, that sort of thing. You might have a claim there, but it's actually quite hard to do. You need to do that pre-inspection before the date of settlement, and then get your solicitor to give you advice on how you actually make that claim. If there is indeed a claim, and sometimes there's not, sometimes it'll be the wear and tear of moving furniture out and things like that. So, you know, you really need to speak to your solicitor in regards to that one. How are we going for time? Okay. Next one. Face says, hi all, we've been working towards planned sealing of our Battle Axe lot in Salisbury, which is in Brisbane, but have not put, but have put the lot on the market, even though the title's not there. So the market is very quiet. We believe mostly because of the fear of building prices. Ideally, my husband and I would have enough money to build a house based on the lot and sell the finished product, but we don't have the money. Is there such a thing as pairing up with a builder after the planned sealing process who will build the house there and sell the split for a profit rather than paying the builder for the construction costs? Thank you so much. Face, absolutely, that does exist. There are many builders that are happy to do joint ventures where you contribute the land and they actually contribute the build process. But you will need to hunt around in order to do that. My suggestion, put the question into the Facebook community and actually ask for any builders in and around that particular area who would be interested in actually doing that deal. Now, before you do that though, it's important that you actually determine what the finished product is actually going to sell for and is there profit to actually be split. You're asking the builder to cash flow the entire build, and if there's no profit to be split at the end, they're probably not going to be able to do that. So you need to put together an information memorandum that actually suggests why this deal is such a good deal to actually get involved in, and then start, I guess, talking to some builders with regards to that. Also, come to some of our meetups. We run these events all the way around the country. You can see the link for our events down below. So come to these meetups, talk to the many builders that actually sit in there. They're always happy to, I guess, if they don't want to do a JV, they'll happily point you to other builders that they might have in their network of people that would be interested in doing that. And there's typically builders at most of our meetings that would be interested in doing a JV. But the other thing I'd say is it doesn't have to be a builder. You might find another person in the community as an investor that might want to invest in that as well. And so, don't limit yourself to just the builder. Okay. Again, make sure that you don't go publicly broadcasting out to the entire world, hey, I need an investor. You need to make sure that you're compliant with the ASIC processes, but you get the idea. Anyway, hope that helps, Thace. Okay, next question. Any ideas on how to value a property if it's being given a development approval? E.g., I have a client's place and don't know where to begin with evaluating the property, which has been approved for 12 apartment complexes plus 16 basement parking. They wanted to sell the property because they can't afford to develop, so I wasn't sure if I was meant to evaluate like a normal house or is another way to do the valuation since it's been approved. Am I thinking too much? No, Paul, you're not thinking too much. Firstly, I would actually get a valuer to do this for you. That's probably the first process. But let me tell you the logic that sits behind this. For you to sell any development approved site to any developer on earth, the only reason they will actually take that off your hands is if there is profit in the deal for them to actually complete the deal. So let's assume that they are going to want to profit. So let's work backwards as to how that person's going to assess the deal. So they're going to be looking at, well, what is the finished product going to sell for you? In this instance, you've said 12 apartments. So what is the 12 apartments going to sell for? Okay, that is going to be the gross realized value. Then you're going to subtract the costs. You're going to have to subtract your GST, agent's commission, that sort of thing. Then you need to subtract the developer's margin that they need to make in order to actually be interested in taking that deal off your hands. If they don't make that money, firstly, they're not going to want to buy it. And secondly, they won't get the finance approval in order to take it off your hands. Then you start subtracting the cost of all the council infrastructure charges and the cost of construction, cost of holding costs, those sorts of things. You work backwards. And then whatever is left over, when you subtract that all from the gross realized value, whatever is left over is the maximum amount that they would pay if they were going to lock in the profits. Okay, now remembering they do want to lock in their profits. So knowing what that is, that figure is going to be what they want to be purchasing the property for. And noting that when they purchase it off you, they're also going to be accounting for stamp duty as they take it off your hands. So you need to account for that in the costs that they're actually going to take it off. So in many instances, a development approval does not actually add that much value to a property because it was either A, the wrong development approval, or B, I guess, the wrong time in the market in order for that deal to actually be a deal. But that's fundamentally how you do it. You take the position of the developer taking that off your hands, and you work backwards from them actually selling that finished product. Hoping that gives you the answers that you're actually looking for, Paul. Now, the next person, MD. MD says, I've seen a couple of developers in the Wyndham, Melbourne area giving heavy rebates on soon-to-be titled lands with flexible settlement dates. Are they under pressure to sell them by a certain time? Thanks in advance. MD, I guess I can't speak to the individual, developers at that point in time as to whether or not they're under pressure. But sometimes people do give rebates in order to, encourage people to purchase, especially when you're coming into, quiet periods in the market. So we've got high interest rates at the moment. So not many people are actually in the market actually purchasing right now. And also we're coming into the Christmas period, which then starts to slow things down. So it looks like they're trying to give some incentives or bonuses for people to actually purchase to encourage them to actually take some action right now. Okay, so from a sales perspective, one of the things that encourages somebody to buy is A, giving them a massive discount, and B, giving them scarcity. So I'm only going to give you the discounts on the next 3 sales, for example. I'm not going to give it to sale number 5. I'm just going to give it to the next 3 sales. That starts to get momentum. And then once they've got momentum, they can then demonstrate to everybody else that those sales have occurred, and the momentum can keep going. So without knowing their particular circumstances, I'm going to guess it's really just a sales tactic to try and get people into, purchasing off the plan right now. Anyway, folks, hope that helps. Hope you've got plenty out of this process. If you would like to participate in an open mic night next time, ask your question, click on the link below, propdev.info/open-mic. Submit your question. That gives me a little bit of time to prepare for the questions and give you the kind of answers that you're actually looking for. And if you do that, then I will present this on the first Sunday of every month as open mic night. Until then, folks, I hope to see you at one of our upcoming meetups. So we run these all the way around the country: Brisbane, Sydney, Melbourne, and Adelaide. At this time of year, we're in the festive season and celebrating Christmas all the way around the place. So looking forward to seeing you at some of our upcoming events. Till then, folks, I'm going to say it's been a pleasure, and bye for now.